Hi everyone, I'm Roy Güllüoğlu. Welcome back to this week's market update video. Following the Fed's meeting last week, we'll recap the key takeaways from their last decision. Then we'll dive into the latest S&P 500 rating analysis from FactSet, which sheds some light on market sentiment. I'll be also breaking down sector-based risk aversion trends to see how different areas of the market are reacting in this current environment. And of course, we'll wrap things up by looking at some key charts to guide the week ahead. Let's jump in. After the 50 basis point rate cut decision, the risk-on sentiment gained momentum. You might recall this slide from last week. Let me quickly recap what we discussed regarding the potential impact of 50 basis point rate cut. As you can see, we were expecting if there was a 50 basis rate cut, there was a risk-on sentiment that was going to come back. Precious metals, at least they're going to protect their value. Large cap growth stock will be benefit out of it, and high risk stocks, cyclical stocks, will outperform the defensive sectors. And in the case of the 25 basis point risk of sentiment, was much more likely. The XY would be expected to gain some momentum, which did not happen. And yeah, with this 50 basis point rate cut, the Fed currently Fed is seen as committed to a soft landing, and market liquidity increased. Technology stocks led buying in indices. Also, the S&P 500 broke new records with the support of cyclicals and high risk stocks outperforming. The dollar index moved down, and precious metals would remain positive outlook. So all markets pricings, all market price acted according to this outlook, our forecasts. If there was a 50 basis point, let's now check the details of those projection materials that were announced in the in the last Fed meeting. As you can see here, on the left-hand side, you see the dot plot table, and on the right-hand side, you see the economic projections. As you can see here, the new dot plot is indicating 100 basis point rate cut for the end of 2024, including September. That means we have there's upcoming 2 more meetings. At least we're gonna see 225 basis points or maybe more in the upcoming November and December meetings. As you can see in the table on the right side, both inflation-related and growth-related economic projections are revised down. What does that mean? Inflation-related revisions that means Fed's expectation is inflation is balanced, it's under control, and on the other side, it is expected that at least some level of economic deterioration in the economic activity is expected by them. During the press conference, Powell made an important point that job market could get worse if things do not balance out or slow down as they hope. Basically, there are concerns about more people losing jobs. We will be following to monitor this closely. The non-farm payroll data for sure as a leading indicator of the economic activity. Atlanta Fed GDP now and weekly initial jobless claims in the upcoming days will be crucial. Accordingly, the Fed's forecast for the unemployment rate revised for 4.4% from 4% by the end of 2024 as an indication of their cautious approach. Here, I would like to mention or highlight a bit the divergence between some data related to economic activity, actually. For example, a non-farm payroll data signaling concern, signaling some worrying issues in job market, while jobless claims doing well. that's we need to watch this data carefully if they're gonna diverge or keep diverging, or we're gonna see like some parallelity between those. But they effectively demonstrated that the risk of inflation and employment are balanced in the Fed meeting. In general, the soft landing still seems to be the base scenario. So let's try to understand the current market sentiment, if it's risk on or risk off, or where are we, to shape our portfolios through sectors reactions, in US equity markets. So there are a lot of indicators that you can evaluate a market sentiment through, for example, Aussie, Australian dollars, Japanese yen parity, because that means Japanese yen is a safe haven. Australian dollar is the exporter of commodities. That means that if economy is doing good, there will be demand for Australian dollar. That means how the yen parity gives some hints about the current situation of markets. That's with that mentality, it's one indicator. Apart from that, oil to gold ratio is another one, as gold is a safe haven and oil is that makes machine work. With that mentality, it's another one. High yield bond yields, TED spreads, and so on. There are you can count on a lot of indicators that you can measure the market sentiment. And one other way to trace this is sector performances of equities, US equities. As we head into fourth quarter, let's take a closer look at where analysts are showing the most optimism and pessimism in their ratings on S&P 500 stocks. I'll be covering this analysis by FactSet to evaluate, if you can see in this slide, FactSet, the general risk sentiment in the market, as each sector reflects varying levels of risk aversion. By analyzing the shifts in buy ratings across different sectors, we can get a clearer sense of where investors are leaning in terms of risk appetite, and which sectors are perceived as safer or more volatility heading into the end of the year. So here, as you can see in this slide, the percentage of buy ratings is slightly below. It's there's a classification is here. Oh, sorry, my bad. Here you can see there's a classification: buy, hold, and sell. 54.5% buy rating is coming from analysts, 40.2% hold, and 5.2% sell. The percentage of buy rating is slightly below its 5-year average of 54.6%. And you can see buy ratings is going around communication services, energy, and information technology sectors have the highest percentage of buy ratings. And hold ratings, you can see that consumer staples sectors, which has the highest, which is known as more a defensive characteristic. And on the sell side, we see that consumer, there's a little mistake here, but yeah, utilities, materials sectors, as these three sectors have the lowest percentage of buy ratings. So what does that mean? Let's skip there. Since reaching a 55.2% at the end of June 2024, the overall percentage of buy ratings for S&P 500 has declined over the past 3 months to 54.6%. When we break it down by sector, consumer staples, utilities have seen the biggest drops from June to now in buy ratings, and with its staples, I think it's dropped from 45.9% to 42.8%, and utility sectors dropping from 50.5% to 48%. On the flip side, sectors like communication services and materials have experienced largest gains. Here, I would like to highlight especially consumer staples and utilities, as they have seen the biggest drops in buy ratings. And on the flip side, you see the communication services and process industries, which is materials, have shown the largest increases. So for like this that means defensive sectors is less favorable still compared to more like a high risk, high growth asset. Here, as you can see in the classification, consumer staples utilities is considered as low risk defensive sectors because, for example, consumer staples is like essential goods such as foods and beverages. Also, like utilities is known as like a stable essential services like electricity, gas, and those kind of stuff. That's why they're considered as defensive sectors, and they're less favorable compared to high risk, high growth stocks like communication stocks or materials. First of all, why communications is considered as more risky? It's telecommunication and media companies, and it is more tied to technological advancements. And on the like material side, it's a bit risky because it's so tied to like a materials price, and like probably like the gold move has huge impact on this like favoring process industries like material sector. Like in general, like there's a picture that still the risk on sentiment. To wrap up, where are we right now through sectors? We can see that as a big picture in the analysts rating, according to analysts rating, still risk on sentiment is there, and with the 50 basis points we also supported this idea. And yeah, before like diving into the charts, I want to highlight some important recent developments in financial markets. First of all, the People Bank of China announced 10 basis point cut to the 2-week reverse repo date, while we've seen some similar support measures earlier in this year. Their impact has been limited so far. That's why I'm watching this cautiously. If you want to watch the potential impact of this move, you can go to Hang Seng Index chart, which is like a pretty well indicator of China's economic situation. And apart from that, we received lower than expected European PMI numbers, signal growing concerns in economies outside of the US. The Eurozone, while less worrisome on the inflation front, now facing some challenges in terms of economic activity. Given the relatively, also by the way, I just want to add one more point about this. There's there's a neutral rate which all yields, long-term yields is expected to converge to this neutral rate. And I recently I read a note from John Waters from Bloomberg that about this neutral rate, that the new neutral rate is still unknown, by the way, but is gonna be higher than the previous assumed neutral rate. And there is a divergence between economies, and currently the neutral rate is much lower in Eurozone than US, and that's because of a saving mentality in Eurozone area, and that's why the need of lower interest rate is much higher. And in that kind of picture, we would expect potential reversal in dollar index at some point, but it's more like a long-term mentality. I just wanted to give as a little note. Yeah, and apart from a Eurozone side, given the relatively hawkish stance of Bank of England, Bank of Japan, and Reserve Bank of Australia, long position in pound, yen, or the Aussie dollar could be considered against euro or USD. In Australian dollar's case, inflationary pressure and support from rising gold play an important role, while Japan's situation still remains unique. As for the Bank of England, although it's delivered one rate cut, the Bank of England held interest rates steady at 5% last week, despite some expectation for a rate cut, which pushed pound higher. For the rest of the week, key economic data releases will play a crucial role. We're gonna receive CB, consumer confidence, and durable good orders will provide insight into U.S. economic activity. And we're gonna receive on Friday PCE data. Will be closely watched for inflation trends. And I think new home sales will be so important in terms of its characteristic of reflecting the lagged impact of Fed's rate hikes on the housing market, because we still haven't seen any very strong impact on housing market yet. And yeah, so let's switch to charts right now. First of all, I would like to start with USD Canada dollar. As you can see, there's in the weekly chart, there's a really not formed yet, but there's a potentially formed a rectangle chart pattern, and as you can see here, you could consider it as a ascending triangle chart pattern. So the Canadian dollar strengthened in September, hitting monthly high as recent economic data supported a less dovish stance from Bank of Canada, because retail sales are expected to have risen 0.5% in August, which is the strongest since April 2023. As just to recall, our retail sales give some hints about inflation. As it comes high, that means inflationary pressure is still there. This has eased the pressure for aggressive rate cuts, providing a lift to Canadian dollar. Additionally, rising crude oil prices recently, fueled by higher demand expectation and geopolitical tensions in the Middle East, have further strengthened Canadian dollar. However, I still maintain bearish outlook on Canadian dollar unless we see improvement in economic activity from China. If global growth concerns escalate, leading to a drop in oil prices, the Canadian dollar would face downside risk. I mean, technically, it doesn't mean that since I remain my bearish outlook, you can play out this as you can see, this trend line seems a valid, and you can since this ascending triangle is a bullish chart pattern, you can just maybe play a long trade idea with a stop just below this let's say 1.34, again a setup like this, for example, being long around here, it's about with a tight stop, because I still believe that as long as we see growth concerns coming out from China, oil prices would be under pressure, and I'm just wondering how Canadian dollar will stay strong amid pressured oil prices. So there's another trade idea that I was looking lately. Here, as you can see, franc yen. So the SMB is expected to cut its policy rate by 25 basis points to 1% at Thursday's meeting, with some arguing for a larger reduction to counter downside inflation risks. Inflationary pressure in Switzerland has already subsided, but with the annual consumer prices, its CPI is around 1.1%, aligning with SMB's 2025 forecast. Last week, Swiss government further reduced inflation forecast to 1.2% for this year and 0.7% for next year. So, and this adds pressure on SMB to ease monetary policy and curb franc's appreciation. Considering the hawkish stance of Bank of Japan, franc yen short trade idea could be worth evaluating here. Apart from this macro side, you can see that here is there's a really nice head and shoulder top chart pattern is formed, but we saw a rejection from this support. But I would be a short, maybe, if I see just a movement like this. I don't know, if we see a turn from me, maybe stop like this, that might be evaluated as a trade idea. But yeah, like I'm watching this Frankian parity like this. And apart from this, another chart that I would like to show in like a 4-hour chart in Mexican peso and Japanese yen. So the Mexican peso strengthened like a 19.3 per USD as like Mexico's let's say surprising economic growth with 3.8% year-over-year expansion in July. That provided Bank of Mexico more room to maintain high rates actually. This sharp growth exceeding expectations lessens the urgency for aggressive rate cuts. And even though like markets are anticipating 25 basis point reduction in the upcoming decision, there's still room. Additionally, I see like a potential head and shoulder bottom here, as you can see in the 4-hour chart pattern. Like while like Japan's like hawkish outlook may not support this trade idea, like being long in Mexican peso, it could be still worth like considering, especially after like a huge depreciation happened after the unwinding carry trades in Japanese yen. As you can see, there's a really nice like chart pattern. Maybe like a trade idea like being long around here with a like a stop around here. That might work out, and maybe tighter stops. Yeah, this was another trade idea. And apart from that, in like gold, I still like remain my like a bullish scenario here. I keep repeating this in the weekly chart, the head and shoulder continuation. The price target of this chart pattern is around the 2,670 levels, and we're approaching that levels. And any correction in this like the trend, I would be following like a 10-week moving average, or in a daily chart, short-term moving averages like 21-day or 50-day moving averages. Okay. Apart from that, actually the agricultural commodities took my attention this week a bit. As you can see, like wheat here, there's a really nice like head and shoulder bottom chart pattern formation is like being formed. Potentially there might be a long trade idea around here. Apart from that, corn, same, like a being long here, and a potential move like this, like the red line is 200-day moving average. And if we see that it exceeds this 200-day moving average, this, I mean, after this huge bearish run, that might be like we might see like a nice rally. And soybean, say, I mean, what I'm trying to say, like both, like all of them, there's like a bottom reversal formations like establishing. In that terms, I think we should be careful. We should take a look on the agricultural commodities. I think like DBA, I think there was also there's an ETF called Agriculture Fund. This was another way to invest in. Yeah, apart from that, I would like to look at like a hard-term agricultural commodities. I would like to show you some US equities. After like China news, as you can see, Alibaba had some like a move, and I'm following this ascending triangle formed in the weekly chart, a potential breakout. As you can see, like pre-market is already higher than this. It might move really well. And apart from Baba, like I had shown this earlier actually, in maybe like a 2 video, like in my like previous two video earlier, like I already given a long trade idea on Meta and ascending triangle chart pattern. It's already like breakout occurred. A potential pullback might be considered to be long on it. And Netflix, there's a really nice cup with handle chart pattern, I think here. A potential breakout might be evaluated as a long trade idea. And Nike, like, I don't know, maybe you heard about this, like a new CEO is coming, like new established, like not new established, but they're like corporate chains are on its way, and I'm just following in that terms, and because it's so cheap right now, as you can see in the weekly chart, I was like just thinking maybe as a let's say joker buying opportunity, and Tesla, it made like a 4% move yesterday, and in the weekly chart, as you can see, I had mentioned this as well. If you're following like me on Twitter, I have already put like some like short videos on how I was following this, and this head and shoulder bottom like chart pattern is being formed here, and yeah, in like daily chart, as you can see, pre-market, it's already moving up, and a potential breakout again might be evaluated as a long trade idea. And yeah, that's all I'm going to talk about this week. And thank you for like your time. And if you like whatever you see here, please subscribe, and share, and please leave as a comment if you have any requests about like content of the video, or if you have any questions about like what I taught in these videos. And please, like if you like, subscribe to Market Soul YouTube channel, and subscribe to Rationale newsletter service. And I hope you have a really great week, and have a good day. Bye.